Let's talk a little bit about the latest from Italy. The Parliament has voted in favour of the populist government's fiscal outline. It includes a higher deficit target for 2019, which has already been sharply criticised by the European Union and as unsettled markets, of course. The yield spread between Italy and Germany's 10-year bonds widened and the FTSE MIB index entered a bear market. Joining us now, Christoph Schon, Executive Director of Applied Research for EMEA at Axioma, and Stephen Major, Global Head of Fixed Income Research, HSBC, is still with us. Christoph, good morning to you.
Morning, Anna.
Let's talk a little bit about Italy then.
Yep.
So we had some comments from the Italian government that the spread over bunds was not going to get to 400 basis points. Your thoughts?
Yeah, I mean, this is something that we've been looking at specifically. When you compare this to the height of the European debt crisis, we were looking at 520 basis points over bunds. Now we're at 300. So we've still got some way to go. But I think what we're seeing is a really worrying trend in terms of the budget deficits. So Italy, yes, they're still below the 3% threshold from the European Union, but they're way above a sustainable growth path or at least in terms of the debt reduction. Now we've seen Spain going in a similar direction. And I think although Contagion has been fairly limited so far, I think there's a bit of a worrying trend, and this is something that we've been looking at in terms of the stress testing that we've done.
Yes. Stephen, your thoughts then? I mean, so Christoph comparing the Eurozone debt crisis with what we see now in terms of that spread. How wide does the spread get from here, do you think?
I don't know whether we can make historical comparisons, because you also know, Christoph, that the circumstances were different. It was pre-QE. There were various measures that came in to help support the market. But we're threatened here with a government that is potentially talking about debt jubilees, and that's very difficult to price because, as you know, we can figure out the debt sustainability calculation, figure out what rate of interest Italy can afford. But the point is, the investor wants to know that he's going to get the coupons and the principal. And therefore, is 3 cheap compared to 2? Or is 4 cheap enough compared to 3? Well, actually, we don't know. There's no number. And we saw this with Greece. It's the market's fear of a restructuring that is the problem here, not whether or not it happens. It's the fear of it. So we
would need to hear some reassurance from Tria and others that that's not going to happen.
I'll give you a simple example. In the UK, it's sterling. It's sterling that moves up and down. It's the barometer for the on-off, the uncertainty. In Italy, they don't have their own currency. They share it. So it has to be the BTP. And they've got to roll over 400 billion next year if you include the bills. Now, if that means the domestics are going to have to be the main buyer, we're going to have to see how much can the banks take, how much can asset managers take, insurance companies, individuals. Then we're going to have to measure how much money is moving out of the country, because that's another challenge. Are foreigners going to want to come in? Well, they will come in if they've got the guarantee that nothing's going to go wrong.
Yeah.
But who's offering that?
Is the large amount of issuance next year going to be an issue, Christoph?
Yeah, I mean, definitely. And I think the question is, how much more can the banks take? Because the banks already own a lot of government debt, and usually in those countries they tend to hold the debt of their own sovereign, which is exactly what we saw in that so-called doom loop.
Yes, that's where the doom loop comes from. Is it alive and well? Is it the same? To Stephen's point about comparisons, though, does the doom loop exist to the same extent now as it did back then because of changes that have happened since?
I mean, if you look at, for example, the FTSE MIB banking index and compare that to the spread of the 10-year BTP over the bund, then they're moving pretty much in lockstep. So you can see that the value of Italian bank stocks is driven by what is happening in terms of the sovereign risk premium. So there is a clear link between the two, and I think it's just a question of time.
Yeah. Is it contagious, Stephen?
Well, there's early signs that it might be if it's knocking on to other markets. From an Italian perspective, the people I speak to are always pointing the finger at other countries and trying to deflect from themselves, I suppose. And if you look at the debt numbers, the private sector in Italy is in great shape. The household and the corporate sector are in really good shape. And people would say, well, what about France? And I know it's typical sort of human psychology, isn't it, to blame someone else or point the finger somewhere else. But the thing is that the contagion is going to affect those markets that also have debt issues and growth challenges and what have you. So I don't think we have to worry just yet. And there's still plenty of time for things to be done. I mean, the positive measures that could be taken could be to incentivize more saving and to give fiscal incentives, tax breaks and what have you, and try and trap the money in the country. There are signs that that's happening.